Greetings, everyone. This is Jake Bernstein. Over here where I am in Santa Cruz, California, it's Thursday at 9 a.m. And whatever time it is, wherever you are, whether it's today, tonight, or already tomorrow, thanks for being here. I want to thank the Foundation for giving me the opportunity to present my ideas to you in the hope that it will improve your trading and take you from being a winning trader to a bigger winning trader, a losing trader to a winning trader, or deepen your interest in the subject matter. I want to stress at the outset that there's nothing to buy. This is not a sales pitch. It's not a gimmick. It's not designed to get you to buy anything. It is purely educational. And as you know, the usual disclaimer, you can lose money trading and so forth. I try to design this in an intelligent way so that you can get the concepts and turn the concepts into trading realities or investing realities. If you want to approach it as a strictly academic pursuit, no problem. If you've been trading or investing for a while, you know that there's a lot of stuff out there. And when I say stuff, I mean stuff. Stuff that won't work. Stuff that looks good on paper, but in reality turns out to be a waste of time as well as a waste of money. It's very important, if you're going to be trading, investing, or doing the science of cycles, that you have good data. Data is very hard to come by in terms of reliability. It's one thing to look at a chart of historical prices and say, I would have done this, I would have done that, I would have bought here, I would have sold here. It's a whole other thing to do it. So when you're looking at a chart, you're living in the moment and you're seeing the entire history flash before your eyes. However, when you're doing it a day at a time, a trade at a time, an investment at a time, it's very different. It's the difference between reality and fantasy, the difference between expectation and implementation. So what we try to do in these sessions is to give you information that will help you make money, or at least help you understand the science of trading in a different perspective. As you know, there are a lot of things out there, as I said. Fibonacci, Gann, Elliott wave, etc. We don't know if those things work. And the reason I say that is because they can't usually be back tested. They're not algorithmic. If you can't put something on the computer and you can't test it, you shouldn't trade it. Seasonality is by far away different. All the statistics are there. We know everything that happened. We can't rewrite history. The prices are what they are. The tools are what they are, and the trades are what they are. As an example, I've taken the weekly seasonal chart for Alphabet Class A from 2004 to 2024, in other words, a period of 20 years. I made one chart that shows the entire 20 years as a trend. Now, you may be familiar with these charts. You've probably seen them before if you understand my work. But the bottom line is, these charts contain a ton of information that will help you immeasurably. Seasonality is far from perfect, but it is, in my view, one of the best things we've got going. You know, when I started trading in the 1960s, late 1960s, there was very little information available to traders. You'd go home, you'd call your broker, or you'd look in the Wall Street Journal and get the open high-low price. You put it on a sheet of green paper, graph paper. You draw trend lines, and you really didn't know what to do because then you'd have to sit and interpret the chart. We don't want any interpretation. We want specificity, clarity, and rules. And pardon the voice, it's going to get better. So if you see things here that you've seen before, that's okay. Learn them and acquire a true and deep understanding of what we do. So let me get back to this chart. And by the way, if you have any questions and they're brief, they may be relayed to me during the session. If it's a lengthy question, drop me a line at the Foundation and I'll be glad to answer it. I usually answer questions very quickly, even lengthy ones, as long as there's an objective answer. So let's go back to this chart. We have taken, mathematically, every year from 2004 to 2024 of Alphabet stock and made the high of each year 100, made the low of each year 0. We've normalized the price. We've removed the actual trend for that year. We've taken all of those years and we've added them together, and we come up with the seasonal chart. The seasonal chart is a very powerful tool because it tells you week by week what has happened. Example, if we go here to this week, and this would be the week of, let me get my chart up a little bit higher here. Just one moment, please. Come on, computer, cooperate with me. Okay, if we go right over here to the third week of August, we see a minus 63 with an arrow down. What does it mean? It means that this week, compared to the previous week, the price was down Friday to Friday, 63% of the time. A very powerful information. Now listen, think very hard. Does the strategy that you're using provide you answers to questions like that? If it does not, you need to rethink your strategy. Humble opinion. And by the way, I apologize in advance if I say things about people, not about people, but about their methodologies that they don't agree with. If I hurt you by telling you that Fibonacci is not one of my methods, don't take it personally. This is all about business, and that's all we care about. We care about being right as much as often and making money as much as often within the context of this procedure. If you want to approach this as an academic venture, you want to write a PhD thesis on it, have at it. But my perspective is strictly pragmatic. Call it mercenary if you want. I want to find things that work. I want to be able to define them algorithmically. I want to put them on a computer, and I want to use deep data to help it learn how to do things better. So here is the model, the seasonal pattern for Alphabet Stock Class A, without any enhancements, just the facts, man, just the facts. So look at the chart. It's not rocket science to see that there is 1 month out of this entire year that historically has had the highest probabilities, and that would be right over here, October. 1, 2, 3, 4, 5 weeks in a row, higher probabilities of close for the week, along with an uptrend. So what does that say to me? Well, it's not rocket science. It says, I want to be long this stock in October, possibly from the 1st, possibly until the end of the month, because that's where the big move is made. So you can be sure that next week I will begin looking for a trigger to get me into this trade. And this is super important. Please pay attention. A timing indicator, which will get me into this trade. It could be a moving average. It could be a crossover. It could be stochastic, could be RSI, could be any number of things, because we find that those indicators which define trend work extremely well with seasonals. So as you can see, there are 2 steps to this process right now. Step number 1, find the seasonal. Step number 2, time the seasonal. Step number 3, manage the seasonal through profit, through loss, or through profit maximizing strategy. Very simple indeed. Not perfect, but much more simple than what most people do. Most people look at a chart and they'll deliberate and they'll sit around and say, what should we do now? What happened here? We don't do that. What we do is crystal clear. Win, lose, or draw. We'll continue. Now let's say that I wanted to see this chart in greater detail. I could just make this chart small, bigger. Let me show you what I mean. I'm taking the entire month of October and I'm representing it as a daily chart as opposed to a weekly, showing me percentage of time up and down daily based on the calendar date. We'll talk about this more next time, but right now I just wanted to show that to you. Let's go back to the weekly chart. Here we go. And remember, ask yourself the question, compared to what you're doing now, does this encompass much more history, much more specificity, much more detail? Is it possible using this type of a chart or this type of a seasonal approach to zero in on the exact day to buy, the exact day to sell? And I say yes, not with 100% perfection, but definitely with good statistics. Now, let's talk about something else. You might say, you've seen this before. Well, think about it. We live in the era of big data. In the 1960s, 70s, and 80s, if you went through a list of historical data and you started looking for patterns, you would be accused of, open quote, data mining. Data mining. Data mining was a dirty word because the implication was that you found patterns in the data that weren't really there, that were artifacts of the data. We're not data mining. Right now, we want all the data we can get to help the computer learn from itself. In other words, deep learning or whatever you want to call it. Seasonality, with its vast amount of data, combined with artificial intelligence, is and will be one of the best methodologies available to traders. I said that 5 years ago, I said that 10 years ago, and we're finally here. So our next step is going to be taking this kind of information and letting the computer learn from it so that it can become even better. Let me show something else. You say 20 years is not a very long period of time. I agree with you. If you're a statistician, you know the longer the history, the more reliable the outcome. So if you're trading with a history of 20 years, as opposed to 40 years, as opposed to 60 years, the information you get from your 60-year chart will be much more reliable statistically than it will be from your 20-year chart. And yet, let me show you something else. I'm going to go over here, and I'm going to select Broadcom. So just bear with me. I want to show you the fundamental mistake that people make. One moment, please. Down in the list here. Here we go. Now let's take a look. Here we go. What's wrong with this picture? Well, right now, the picture looks pretty good. And wow, you look at it and you say, my goodness. Let's go back. Just one moment, please. I'm too quick on the mouse. People say, wow, look at this. I want to be long this stock every single day, beginning in January, ending in March. That's the good news. The bad news is there's not too many years of history in this database. Look, from 2009 to 2020, actually 2023. So the limited amount of years is what causes this to happen. At some point, the data regresses to the mean. Would you rather have something like this or something like this? Let me show you another one. In fact, let me show you the best seasonal trade that's coming up the entire year. Dow Jones, right over here. Just bear with me. And here comes the Dow. 1920 to 2024. So we're talking over 100 years of data here. So I ask you to think about this. Is the methodology that you're using so extensive that it covers 100 years of history? And I want you to think about what has happened during that 100 years. We have had world wars. We've had the Gulf War. We've had the Middle East wars. We've had the embargo. We've had practically every condition, including the Great Depression, and yet the charts continue to point in given directions with high probabilities and regardless of who has been in power. So again, let me quiz you. I want this to be an educational experience for you as well. Think for a moment. Think. Look at the chart and think about what might be a high probability trade. My eyes are immediately drawn to this right over here. The first 3 weeks of April. Remember, these probabilities up 66% of the time, up 64% of the time, up 65% of the time. 1 week of no strong prediction, and then the first week of May, so it can include the entire move over here over the last 100 years. Very incredible and very accurate. What could we do with this? We could zoom in on this and ask the computer, Do an iterative process. Run through the data and give me the best combination that will take advantage of this move right over here. And I will show that momentarily. But I want to show you something just as good, maybe even better. Let's go back to the search. Right over here. In fact, let's do this a little bit differently. And I want to stress, any good piece of trading software for seasonals can find these patterns for you. You're not obligated to use this one. There are a number of them out there. Some of them give you more information than this. But the good news about seasonality is it gives you valid, solid information. And that is super important. So let's go to right over here, seasonal trades. And we're going to go to US stock trades. And remember the month of October. I'm going to go to S&P. And remember, I'm showing you a process. You can use this process any way that you like because it will give you very statistically reliable answers. Okay, let's go to S&P. And let's ask a question. For the month of October, has there been anything that's been reliable, predictable, 75% of the time? And by the way, if you've seen me do this process before, that's all right. It's an important process. I do it once a month. So in other words, in a week or so, I'm going to be doing this process for all of my stocks and all of my futures to get my list of trades for the month of October based on seasonals. You can use your own methodology if you want to, or you cannot use this at all. But I submit to you, with all due respect, there ain't nothing like this out there that gives you the statistics that you need to make an informed decision. Whether you do it or not is up to you, of course. But the importance is this: the data is there. So I'm going to say to the computer, can you show me, one moment please, can you show me all trades in the month of September, the month of October, in S&P 500 that have been right 75% of the time or more? Is that all you want to know? Do you want to know risk? Yes, I think risk is important. So I'm going to say to the computer, I don't want to risk more than X percent. I'm going to put that right in here. Let's just make it a very reasonable number, 5%. I'm also interested in trades that last at least 30 days. So I'm going to put 30 in here. And what the computer is going to do is it's going to go through trillions of combinations very quickly and ask the question, is there anything here in this database that gives me what I want, what I'm looking for? If it's there, it'll find it and give it to us. If it's not there, it'll just tell you there's nothing there. And remember, this is a very basic program. This program was written for me by Dr. Richard Smith of the Foundation many years ago, and still today, it's, in my view, the preeminent program for finding seasonals. And let's take a look. Well, isn't that interesting? The computer says yes. There's a page of trades over here. Let me show you. And what the computer has done, it has arranged the trades in order of best to worst. It took the trade with the highest percentage win at 78%, put it in the first position, and you can see the others are all lower in terms of probability of success. So I opted to default to accuracy. If you wanted to default to average profit, you would simply do this. Put the biggest winning profit on the top of the screen. Let me show you. Here we go. So this trade would be 32 points rather than the one that we chose before. But here's the most important thing. Let me go back to the original trade. One moment, please. And that was percentage win. Here we go. Let's take a look at the results. There is 64 years of history, as you can see. And I want to stop right here and ask you the question. If you're an experienced trader, or even an inexperienced or relatively new trader, how often have you seen any methodology that traces its roots back 60 years and then show you the data as to what happened with those particular setups? There's nothing like this around here. But yet, people still want to trade based on what they don't know, as opposed to trading based on what they do know. And this is a very extensive record. Here it is. Is it perfect? By no means. Does it have drawdown? It certainly does. Does it have great successes? It certainly does. It's not perfect, but it certainly gives you a direction as to what the market should do. And remember, I use a 3-step process: setup, trigger, and follow through. We've seen the setup, which we're looking at right now. We need a trigger. A trigger would be any one of those regular timing indicators that people use, or we have our own trigger, which I'll be teaching in future sessions. Very simple. Now, let's take a look at some more data. One moment, please. Let's say that this game was too long-term for me. After all, to some traders, 30 days, the only kinds of trades they can be in for 30 days are losing trades. Traders love to keep their losers till they grow hair on them. They'd like to get rid of their winners quickly. So let's just change the expectation. Let's go back to the search. And let's just say we don't want to be in trades for more than 10 days, like so. And furthermore, we don't like the risk. We want to take less risk. We want to take 3% risk. We're going to find out. Is there such a beast in the program, in the history? Here we are. 75% wins minimum, 3% risk, and less than 10 days. Let's look. The suspense is killing me. Well, lo and behold, we have it. Right over here. The first position. And again, I want you to understand. The reason the computer put this trade in the first position is because it has the highest accuracy. You can trade for accuracy, or you can trade for average profit per trade, or any of these other points over here, but I prefer accuracy. Accuracy is a great confidence builder. If you're accurate in your trades, even if you're making less money, you will have the courage to trade bigger positions, which will compensate for making less money. Let's take a look at the results. Right over here. Here's the history. And let's look at the track record. All the way down here. And there's the results. So you can see it hasn't been as volatile as the other methodology, as the other dates, but still does its job. Let's go one more step back. Let me show you something else. What does this look like on a seasonal chart? Let's take a look. Here we go. This is that tiny sliver of the trade that's taking. This tiny little sliver right over here. Does that mean anything to you? I want you to think about it. If you place a position right over here, and by the time the trade is over, your position is profitable, is it possible to take some money off the table and keep your position for the rest of the move, which is right over here? It certainly is. And this is the part 3, profit maximizing strategy, a very effective methodology for turning your small winners into big winners. Now, let's go back and let me show you something else. And the reason I'm giving you this whirlwind tour right now is I want to get more specific over time. I want to show you how you can even use seasonality for day trades, because I know that everybody loves day trades. Let's go back here. And let's go to seasonal trades, futures. And let's go to the left-hand side. And let me say one more thing. Seasonality, as you can see, is not related to the seasons. There is a seasonality trend in the grain and commodity prices, but it's not a seasonal in the terms of the seasons of the year. Seasonality, as we use it, means only one thing: the tendency for prices to go in a certain direction at certain times of the year. That's all there is to it. And we want to find those certain times of the year through using the computer data historically. So example, one of the big hits from the last show I did was the copper chart. Do you remember that chart? It peaks around this time of the year. It peaks around March or April, and then it begins to bottom around this time of the year. We can go to copper, and we can ask the question, for the month of October, have there been any buying opportunities in copper that have been correct at least 75% of the time? Here we go. And ask the question, what do we get? No, there haven't been. Very valuable information, because it's just as important to know when not to trade as it is to know when to trade. But let's ask this question. Maybe we're expecting too much. Do a little research here. Let's say that we will be happy with 70% accuracy. Is there any such animal here? No, no problem. Research says, let's go to November and December. Here we go. November and December. And let's see if there's any such animal here. Oh, indeed there are. And again, the computer has found 19 pages of these and put the best one in the first position right over here. Buying copper, March, end of day, December 18th, getting out end of day, December 25th, with all these data, including the stop loss and everything. Doesn't this tell you everything you need to know with one exception? And that one exception is it going to work this year? Let's see if we can glean a little bit of quality information from the history. We're only talking about 52 years. As you can see, 52 trades right over here. Let's go all the way down. Look at all the history. Magnificent. And it has had some very big winning years, especially lately. And this is the equity curve. No guarantees, but I can tell you that I will be out there looking for a trade to trigger. Definition, trigger, timing. Trigger equals timing. That's the most important thing. So there's a trade that we have right now. Let me show it to you because it's losing money and I want to show you the losers as well as the winners. Let's go to S&P and I'll show it to you. It's S&P futures. And I realize I'm going rather quickly. There's a lot to tell. Remember, we're going to look at stocks, futures, grains, soybeans, metals, everything. So here we go, S&P 500. And let's ask the question, anything for the month of September on the short side? Like so. And the answer comes back, yes. Going short September 16th, getting out September the 25th. If you know what the market's been doing the last 2 days, you will know this trade has been dead wrong. In spite of a magnificent track record with 81% accuracy. How could that be? Look at all this data. And this is so important what I'm going to tell you right now. It doesn't matter what the data says. If you can handle the stop, this trade's okay. If you can mitigate the potential risk, this trade's okay. So how would you mitigate this risk? Easy. Remember, there are a number of vehicles for trading. Stocks, futures, options, ETFs. So in this case, in order to protect your loss, in order to protect yourself from a loss, you would buy a put option. because a 3.5% stop loss only risk of the entry price of the S&P would be a significant amount of money. So that's what we do to manage risk. So what we have seen is setup, trigger, and partially the follow through. And here's a trade that didn't work. Lest I be accused of only showing you things that work. But let me show you something else. Let's return to the search, like so. And let's go back and ask another question. How about gold? Gold is here making new all-time highs. Can we get information on gold? Again, drawing from the lessons of history. Take a moment and think. Think about the methods that are available out there. Is there anything that you have found that gives you as much history as this? And yet, what's so strange about it in my travels throughout the world, teaching traders all over the world how to trade, I find that people would rather rely on their opinion or the opinion of a government official as to what's going to happen, as opposed to the validity of history, which is massive. And with the addition of AI, it's going to even be better. Okay, so we're asking the computer, any trades in gold in September with 70% accuracy on any side of the market, long or short? Like so. And has the question. Oh, yes, there is. And it says buying September 15th, getting out September the 25th. Let's say that we were anxious to get in sooner with reliable percentages. Let's check it out, because look what we have here. We've got some very big percentage winning trades. So let's do this. Let's sort for the date, the entry date, like so. And the first thing that we could do is we want to be buying gold the 1st of September. And by the way, I call this my birthday trade because September 20th is my birthday. But notice this. In order to take this trade, you would need to risk 100% of your money. We don't do that. So we go back and we say to the computer, be realistic. Put in a stop, please. No problem. Let's say we're okay with a 5% stop. And by the way, as we go through the lessons, through our classes, I'll be fine-tuning all of this for you and help you understand how to find out what's right for you, because the use of this powerful tool is not going to be the same for everyone. So we're asking the question, September trades in gold. And here we are, September 15th through September the 25th. But again, we're anxious. We want to get in sooner. Is there anything that will get us in sooner? Let's find out. Here we go. The earliest we could be in would be September the 14th through September the 25th, 21st. And it's a relatively short-term trade. Let's take a look at the history. Here we go. So we're looking at 49 years of history. And for me, it's very revealing to take a look at the cumulative profits chart. Notice what's been happening. One huge year in gold on the long side, but in the last 10 or 15 years, it has definitely deteriorated. The curve is starting to point lower, meaning what? Meaning, in my view, the statistical probability of gold being reliable in a certain direction at certain times of the year is coming into question. There are some fundamental changes happening here. So let me show you something that's going to be very valuable to you. In fact, I think all of this will be, if you appreciate it, and I hope you do. Look over here. Max loss and growth. These are very important variables. This means that this trade, specifically by the rules, has been wrong at some point 4 times in a row. That's not only a great remover of capital, but it's also a remover of confidence, and it shows no growth. What does that mean? It means this trade is not very interesting to me. I will not likely take this trade. However, that doesn't mean I can't go back and ask the question, is there anything in October? Let's find out. Here's the Octobers. And now we're looking a lot differently. Great percentage wins. October 27th through November the 6th. And positive growth. Let's look at the history and compare. So you do have to make some decisions, but they're objective decisions. Here's the history. 27 years. Let's go all the way down to the bottom. Now we're talking. This is the kind of a trade that I would rather have. And by the way, you can only find these by doing a little bit of research. But here's the good news. We can teach AI to do this lickety-split. And that's going to make the world of difference for seasonal traders. Think about it. Let me tell you one more thing. This is not a new trade. It's been around for years. People have known it for many years. But I want you to think about the thing that people say. If everybody knows it, it's not going to work. Well, this flies right in the face of that. Because not only did, quote unquote, everybody know it, but it turned in its best performance ever. What can be expected this year? Always expect the trade to not work. Take your loss up front. If it's a 5% risk, think about how you would feel and what it would do to your account if you lost 5% of your equity on that trade, or 5% risk on that trade. What would it be in dollars? And compare that dollar decline to what it would do in your account. Let's go back. And I hope I'm not throwing too much information at you. And by the way, Dan, if there's any questions for me, I'm happy to take them. Let's go back here and return to the search. Like so. Let's say that you didn't want to trade gold. So let's do this something different. If you're a grain trader and you look at grain prices, you can see that they are following their usual seasonal trend. How do we know that? You can run the chart. Let me show you what I mean. US futures trades like so. And let's go to soybeans. Let's go to the seasonal charts. US seasonal charts. And let's go to soybeans. Just bear with me for a moment, folks. There it is. There is so much data here, it takes a little while. Let's go to soybeans, just so that we don't disappoint our farmer clients and our hedgers. And let's go to the the January soybeans, actually. Sorry about that. Here we go. March beans, Jan beans. Like so. And let's take a look. There we go. So this is rather interesting. We have September right over here. Well, guess what? We are coming into the beginning, the possible beginning of a seasonal trend to the upside in soybeans. And look at the size of this move in the month of October. So what are we going to do? It's time to fine tune. Let me show you, and I hope I'm teaching you some good skills. And by the way, one more thing, please let me hear from you. I want to know if I'm helping you, if I'm hurting you, if I'm not being clear, if I am being clear, if I'm changing things for you for the better. That's what does it for me. So thank you for the foundation for letting me do this. Okay, so here we go. We're going to go back to October, and we're going to do a search. Soybeans in the month of October for what? For a buy seasonal. So how do we do that? Piece of cake. Go to seasonal trades, US futures trades. And we're going to go to soybeans. And by the way, if I can do this, anybody can. Hold on, please. Soybeans. October. And leave the search wide open. You're going to say, I will take anything I can get. And let's do a search. Well, isn't that interesting? We've got some. The top one, October 28th through November the 7th. Think about the chart. Let me show you again. But there's a little problem here, and you can probably see what it is already. So what I'm trying to get you to do is how to think seasonally. Let's look at the history. Okay? You know, it's a okay history, but it doesn't give me the warm fuzzies. I'd like to see something better than this. True, it's grown, but it's grown very slowly. So let's take a look at the seasonal chart and find out what's going on here. Here's the seasonal chart. Does it look like the one we just looked at before? Let's find out. Do your thing, computer. Here it does. It does what we wanted it to do. However, it's not zeroing in on a sufficiently large move. So, one moment, please. Let's go back to the weekly chart. So what are we going to be doing? Over the next 2 weeks, we're going to determine how to get into the soybean market, how to get into the S&P and gold and so forth. I will help you with fine-tuning on this methodology. So your assignment, if you want one, ask me questions, please. I know this stuff. I've been trading for over half a century. I can help you considerably. So don't hesitate to ask questions, even if you feel they're foolish questions or elementary questions.
Jake, we have one quick question specifically in the column titled growth. What is growth relating to?
Perfect question. The computer looks at the cumulative profit. In fact, let me do this. Let me go back to seasonals. I'll show you. One moment, please. That's a great question. Here we go. And let's just take the Australian dollar, for example, and run up some seasonals. Here we go. Let's show all months, like so. Let's do a quick search. And let's take this top trade, 83%. Let me run the history. Here we go. Growth asks the question, is this trade growing in its cumulative results? So it compares the current year with the last year, with 15 years ago. So this would be positive growth if this was 15 years. So you can do it. Either the computer does it for you or you can do it on your own by looking at 15 years ago. You want trades that have positive growth, indicating that seasonal has continued to work over time. And this is a beautiful trade that we found, by the way. Look at that. Okay, any more questions, Dan?
One more specific question. What are the up-down arrows in red and green versus the plus and minus, which are also in red and green?
Super question. Let me go to a seasonal chart. Here we go. And bring the chart up, and I will explain it. One moment, please. Okay, chart, here we go. A green arrow means statistically significant move to the upside. A green number gives you the percentage to the upside. A red number would do the opposite. So the green appears on any trade that's been right 60% of the time or more. A red one will appear any trade that's been right 60% of the time or more on the downside. That's what they mean. Any other questions, Dan?
If you have the time, Jake, we did have a request for an analysis of the weekly seasonal chart for soybean oil.
Let's do that. Let's go to the soybean oil. Just bear with me for a moment. Let me go to the seasonal charts and US futures. And let's go to the soybean oil. Soybean oil. And let's leave it at the March for now. And we'll take a look at the chart. There's the soybean oil. And what it says is expect a seasonal low toward the end of the year, beginning of next year. There's a very good seasonal move to the upside over here. And this are 2 weeks to the downside in December. And this is just about where we are coming into right now. So we do have 2 weeks to the upside over here, which should be pretty reliable in the 60% range. And the green shows the magnitude of the move. So, Dan, thank you for relaying the questions. Everybody, thanks for being here. I appreciate it. Remember, please write. Please get your friends to watch. I think you'll be doing them a great favor by teaching them this very powerful tool. And we'll be back next week with better stuff.